The Federal Reserve, often referred to as the Fed, is the central bank of the United States, and its decisions have far-reaching effects on the economy and on your personal finances. While the Fed may seem distant from your daily life, the policies it implements have a direct impact on your wallet. Whether through interest rates, inflation control, or the overall stability of the financial system, the Fed's actions influence everything from the cost of borrowing money to the price of goods and services. In this video, we'll explore the top 10 ways the Fed influences your wallet and financial well-being. 1. Interest rates on loans and mortgages. One of the most visible ways the Fed influences your wallet is through the setting of interest rates. The Fed controls the federal funds rate, which affects the interest rates banks charge each other for overnight loans. These changes ultimately trickle down to consumers in the form of higher or lower interest rates on mortgages, car loans, and credit cards. When the Fed raises rates, borrowing becomes more expensive, leading to higher monthly payments for loans and mortgages. Conversely, when the Fed lowers rates, borrowing becomes cheaper, helping to reduce monthly costs for those with loans or mortgages. 2. The cost of credit card debt. Credit cards are a common way for people to borrow money, and the interest rate on your credit card is often linked to the Fed's federal funds rate. When the Fed increases interest rates, the rates on your credit card balances may also rise. This makes it more expensive to carry a balance from month to month, potentially leading to higher debt and more interest paid. On the other hand, a rate cut by the Fed can make credit card debt more manageable by lowering interest charges. 3. Savings account interest rates. The Fed also affects how much you earn on savings accounts. When the Fed raises interest rates, banks may increase the interest rates on savings accounts and certificates of deposit, CDs, to stay competitive. This means you could earn more on your savings, which is great for anyone who relies on interest income. However, if the Fed lowers rates, banks may reduce the interest paid on savings accounts, making it harder to grow your savings. 4. Inflation and the cost of living. Inflation is the rate at which prices for goods and services increase over time. The Fed closely monitors inflation and adjusts its monetary policies to control it. When inflation is high, the Fed may raise interest rates to cool down consumer spending and reduce price increases. Conversely, if inflation is low, the Fed may lower rates to encourage spending. High inflation erodes purchasing power, meaning that the cost of everyday items such as groceries, gas, and housing can rise faster than wages. The Fed's actions directly impact how much you can buy with your income. 5. Mortgage rates and home affordability. Mortgage rates are heavily influenced by the Fed's actions. When the Fed raises or lowers interest rates, it directly impacts the interest rates on home loans. Higher mortgage rates make homes less affordable, as monthly payments increase. On the flip side, when the Fed lowers rates, mortgage rates typically decrease, making it more affordable for buyers to finance a home. If you're looking to purchase a home or refinance your current mortgage, the Fed's decisions play a critical role in determining how much you'll pay each month. 6. Stock market performance and your investments. The Fed's monetary policies also affect the stock market. When the Fed raises interest rates, borrowing becomes more expensive for companies, which can lead to slower growth and lower stock prices. In contrast, when the Fed lowers rates, it can stimulate economic growth, boosting corporate profits and potentially driving stock prices higher. The Fed's actions often influence investor sentiment, which can impact your retirement account, stock portfolio, and other investments. Understanding the Fed's policies can help you make better investment decisions and prepare for potential market shifts. 7. The value of the dollar. The Fed's policies influence the value of the US dollar in global markets. When the Fed raises interest rates, it often strengthens the dollar, as higher rates attract foreign investors seeking better returns on their investments. A stronger dollar can make imports cheaper and reduce the cost of international travel. On the other hand, when the Fed lowers rates, the dollar may weaken, which can make imported goods more expensive and raise the cost of international goods and services. A fluctuating dollar directly affects your purchasing power, especially when shopping abroad or buying foreign-made products. 8. Employment and job growth. The Fed has a dual mandate to promote maximum employment and stable prices. When the Fed adjusts interest rates, it can impact job growth. Higher interest rates may slow down business investments and consumer spending, potentially leading to slower job growth or layoffs. Lower interest rates, however, can stimulate spending and investment, leading to more hiring and lower unemployment. The Fed's actions help shape the job market and can impact wage growth, job opportunities, and overall economic stability, all of which directly affect your income and job security. 9. Bank fees and service charges. Banks use the federal funds rate as a benchmark for the interest rates they charge on loans and pay on deposits. When the Fed raises interest rates, banks may respond by increasing fees for various services, such as account maintenance, ATM withdrawals, and overdraft charges. These increased fees can put a strain on your personal finances, especially if you rely on these services frequently. Lower interest rates may lead banks to lower fees or offer more attractive terms for depositors, providing consumers with some financial relief. 10. Your retirement funds and pensions. Interest rate changes set by the Fed also influence the returns on bonds and other fixed income investments that are often part of retirement funds or pension plans. When the Fed raises interest rates, the value of existing bonds may decrease, which can reduce the value of a retirement portfolio that holds bonds. However, if you're contributing to a retirement fund or pension, higher interest rates could lead to better returns on new bond investments, helping your savings grow over time. It's important to keep an eye on the Fed's actions to understand how your retirement investments might be affected. While the Federal Reserve's policies may seem distant from your daily life, they have a profound impact on your finances. From the interest rates on your credit card and mortgage to the performance of your investments and the cost of living, the Fed's decisions influence many aspects of your wallet. By staying informed about the Fed's actions and understanding how they affect your finances, you can make better decisions about saving, borrowing, and investing. Whether the Fed raises or lowers interest rates, its decisions will continue to shape the economy and your personal financial future.